In this video, we're going to talk about using life insurance to buy a 275 unit apartment building. If you are not familiar with who I am, my name is Dom Rufran, and on this channel, we focus around financial education, specifically around all things life insurance. I have helped put billions of dollars of death benefit in place for families and over hundreds of millions of dollars of cash value currently in force to be able to borrow and utilize for multiple activities. I've ran thousands of illustrations, seen lots of terrible ones, lots of okay ones, and some good ones. And in this video, what we're gonna do is we're gonna focus on the really good cash value rich policies to be able to store capital, to be able to utilize for a deal like this. So with that being said, let's go ahead and get into it. So let's talk about using life insurance to buy a 275 unit multifamily property. So first, what I want to do is I want to discuss why multifamily in general and why I think that using life insurance in tandem with it is going to be a great opportunity. One, this isn't investment advice, but what this is it highlights using life insurance in tandem with investments. And most people want to have the conversation of like, should I put my money into life insurance or into this investment? What I'm here to say and tell you is that it's not an or conversation anymore. It's an and. Put our money into life insurance. And then what we want to do is take the money from life insurance and then put it into the investment opportunity. That's why we call it the and asset here at Better Wealth, is because we're able to do both now. So when somebody says, oh, that's a terrible investment, life insurance is a terrible investment. Yeah, that's true. Life insurance is a terrible investment. That's why I'm not going to talk about it as an investment in this scenario. What I'm going to do is I'm going to talk about life insurance as a foundational asset. To being a foundational asset, think of it kind of as that solid foundation to where we can start building all other financial products and financial utility on top of that. And so first, get the floor, get the foundation in order, which is the life insurance policy. Then what we can do is we can move into other incredible investment opportunities across the board. And that really going to come down to you as your greatest asset and what you believe is a great opportunity for an investment. For myself, personally, I love multifamily, specifically syndication deals, which is what this is. If you're not familiar with syndication, syndication is essentially a group of people that come together to help buy an investment fund and help buy a property based off of a couple different parameters. Now, you can go out all by yourself. You can go buy a real estate deal, and it's going to take a lot of resources, a lot of capital, a lot of time, a lot of energy. And if you're able to do that all on your own, you're going to reap a lot of the benefits. You don't have to share any of the profits. You don't have to share anything when you sell. You get to keep all the cash flow, all the depreciations, like everything within the actual investment you get to keep. But to do this at a very high level in the multifamily apartment building space, there's lots of multifamily, but specifically apartment buildings, it is so competitive out there that you really do need to find experts that are doing this full time. If you're not doing it full time, you can pretty much say adios to having any type of competitive advantage in the space. Because there's people that do this 24/7, 365, that are doing it day in and day out, doing the research, have a massive team. So what a syndication is you have two different types of people. You got a limited partner and a general partner. The general partner is the people that go out and find the deal, the ones that control the contract, that are doing all of the work. And then the limited partner is the one that is essentially giving a paycheck. So in this scenario, I want you to think of you and this individual as the limited partner. The limited partner is going to be the one that's going to write a check and give it to the general partners. And by doing so, you essentially invest your dollars and then reap a return. And the return is usually has cash flow within it. There's tax advantages within it. And then when you sell, you then get a return back on that as well. So it becomes more of a mailbox type of check because you're not doing any work after that. The general partners are the ones that are doing all of the work. They're managing the property, their negotiations, they're kicking out tenants, they're fixing things, they're doing all the property management, CapEx, which is essentially your budget to fix things. They're taking all of that budget, they're making the adjustments and fixing things, raising rents. They're doing all that fun stuff. What you do is you just reap the reward and get a check every quarter, monthly, a dividend check. Like sometimes it really just depends on how well the property is doing. So it's important for a lot of different factors that we're going to discuss with looking at the actual investment, the team, so on and so forth. But the reason why I like it is me being somebody who's heavily involved in business, I don't have the time to be full-time real estate investor. I just don't, because it takes so much energy to be really good at that. So because 98% of all my time goes into business, I want to be able to, the other 2% of the time, go ahead and read a deck, which is essentially gives you all of the specs for the real estate deal. Look at the memorandum and make sure all things are good, which is essentially this big contract and everything that is within the expectations of the property and the deal. And then be able to vet the people. And if I like everything about it, then go ahead and be able to invest into it. And then by doing so, I'm able to focus on the one thing that I really enjoy, which is business, and then be able to diversify to some degree, not my time and energy, but maybe my resources into something else like a real estate deal. And that's why I think that doing something like this that we're going to talk about is an incredible opportunity. And then when you start piecing in life insurance, which I'm an expert in and understand, and be able to have the two powers come together, this is where the real magic happens, and you can really start building incredible wealth. So what we're going to do is we're going to start with looking at the investment highlights of this property, and then we're going to go into the actual investments returns and then the life insurance returns, and then combining them together and see what the total is at the end. So with all of that being said, let's go ahead and take a peek. So the investment highlights, this is a real property, real everything. So I just wanted to be fully transparent with that. This property is in Florida, and there's a lot of great opportunities and advantages for having properties in Florida. That's tax advantages, location, weather. A lot of people are moving there. You know, it's a place where a lot of people really want to retire. From a conservative value perspective, there's a lot of people that are moving there from that place's perspective as well. So that's why Florida, prime location, growing, strong economy. What they're doing with this property is they're renovating at 99% of all of the units. And so when they do that, they're able to then increase the rents. And by increasing the rents, they're obviously going to increase the cash flow, which obviously increases the profits, which then goes back into your pocket. Management, 20 plus years, proven track record. I think it's super important that you do your due diligence. There is lots and lots of opportunity out there, but not all of them are great opportunities. There's people that will scam you. There's people that will rug pull you. There's people that will take your money and create and make it seem like it's a great opportunity, but really it's a Ponzi scheme. And if you're not familiar with a real Ponzi scheme, it's taking your dollars and giving it to the next person, which then gives it to the next person, and giving returns without any real product or service. So it's really important that you do your due diligence, background checks, referrals, that this person that you referred is a good, that you trust the person. It's obviously big. And I think that the track record of that person, that they've done this with multiple deals for a long period of time, is super important in today's world. People are just now starting off and they're like, yeah, I'm a syndicator and I'm a general partner, and they're doing this for the first time and don't have any real track history, no real partners in the thing that have done it for a while. Just lots of red flags that can go up. So I think that's super important, that the experienced management team really is probably one of the most important things when it comes to looking at investment opportunity. And then attractive returns across the board. We're going to look at those here in this next slide. So real quick with the property overview, this is the name of it. Like I said, I wanted to be fully transparent and give you a real live property. Rise Blue Ridge. It's in Lakeland, Florida. It was built 1986. Like we discussed, there's 275 units, Class B. If you guys aren't familiar with classes, it goes Class A is the highest, all the way down to, most of the time you're not getting below Class D. Because if it is, it's essentially not livable after that. And usually even into the D, it becomes kind of sketchy as well. But just know that Class A is like really bougie, high end, turnkey. B is like next, super nice, still nice, really good. And then C is like, okay, now we're getting into a little bit more of the ghetto side of things, but lots of opportunity to then go ahead and fix up and go ahead and build. And usually when you're at the higher Class A, it's less risky. You really don't have to worry about some of that perspective. And then when you get to lower B, C, and you start to get lower from C below, you now have to start worrying about some of the risks that are involved with filling the people. Are you going to have enough money to have some CapEx you have to raise to have things fix up? Is all things going to go well? You're not going to have units that are going to be filled up for a little while. So those are all things you got to have to put into perspective. And with it being Class B, 95% occupancy, which means that 95% of the property is completely filled up, which is obviously very important when it comes to the cash flow piece of it. So here's some of the financial projections for the real estate deal. 35 million is what the cost is to buy it. So this is a conversation of using life insurance to buy multifamily, 275 units. When it comes to syndications, you are a piece of the puzzle, okay? You are not buying all $35 million of it. Most syndication deals, okay, require a minimum of $50,000. I have seen other ones that, Grant Cardone does this type of stuff where you could do even less, $5,000. I've seen some online ones where you could do lower amounts as well. Usually some of like the really good ones, proven track records, that provide really solid returns, not super high fees. It's usually $50,000 minimum. So when we're looking at this, just kind of think about that. If you don't have at least $50,000 saved up in general, you should not be looking to invest into things anyways. You should really be investing back in yourself, putting it into a safe bucket. And then once you get at least $50,000, that's when you can now start making better opportunities, better decisions to then go ahead and deploy into investment opportunities. Until then, get your household in order, get your income up, get your skill set up, get your debt knocked down, do the things that are important to then be able to then invest larger buckets of money to get a higher rate of return. And so even when you're starting these life insurance policies, like if you put $10,000 a year, which is still really small, into a life insurance policy, you have to save up, a couple of years, 4 or 5 years before it like really makes sense to think about investing, which is okay. If you're younger, you have time on your side, let that compound and grow. But if you're like already in your 40s and 50s, that's where it's like, you got to start contributing more money to your life insurance policies, $15,000, $20,000, because you got to kind of speed up this process. So that's why all of these opportunities are great. Life insurance, real estate, they all have their advantages. But if you don't have your income and cash flow and debt and all of that stuff taken care of at home, none of this stuff matters at the end of the day. So you have to get the foundation correct to then be able to start moving forth. So with that being said, with the syndication, you being the limited partner, again, you are writing a paycheck to the general partner. You are going to a minimum, right, probably close to $50,000 of this $35 million. So there's a lot of people that are participating in this to make this thing work. So you're not using life insurance to buy all of it, but we will take a loan against our policy of 50 grand to then be able to do into this deal. And the examples that we're going to use is actually going to be $100,000 to give you an idea of what is possible on the returns from this scenario. So based off of the deck, the memorandum, the financial projections, all of this stuff, annual cash flow is 5.3%. So per year, put in 100 grand on average, you should receive back right around $5,000 per year. Projected internal rate of return, that's what IRR stands for. So when it's all said and done, total amount of money based off of cash flow and also return on your dollars should be around 16% per year over, and we're going to look at a 5-year window. And from an equity multiple, I put in 100 grand, I should have gotten 2x back, 200 grand plus my actual return is what the multiple will look like. And then from a profit split, 70-30, all that really means is, we're talking about the actual deal in itself, not life insurance, because you can kind of get confused. If you're very familiar with life insurance, we talk about base to P ratios. Base, you could be like 30% to 70%. So we're not talking about that right now. This is specifically just with the financial projections for the real estate deal. 70% is going to go to the limited partners. So pretty much everybody that's funding the deal. And the really good general partners, they actually invest their own money, which they can be part of that kind of limited partner structure. But majority of the time, the 70% is really going to make up all of the limited partners, people that are the passive investors. That's the best way to think of it, the passive investor versus the active investor. And the 30%, obviously, if you're actively finding the deals, doing the due diligence, doing all of the fun stuff, quote unquote, it takes time and energy. They deserve to get paid as well. And then that 30% goes to them as well. But there's a lot less of them. Usually it's about 5 or under general partners that I've seen. I usually haven't seen more than that. That's what that 30% gets split in. They're doing a lot of work though, so well deserved. All right, so let's look at the actual returns on the investment for the $100,000. 5-year hold when we're looking at it. Again, $100,000. 5.3% on average over a 5-year window. It's going to be $26,508 of cash flow over that 5-year window. And then the return on sale is going to be a total of 178,862. So that gives us for the IRR of 16% per year. Essentially what I've done is taken this 26,508 plus this 178,862, add them together, gets us to 205. Divide this by the 5-year window, this gives us an actual 16% on average is what that will come back to. So then on profit, you take out your initial invested of 100 grand, you have about 105,370 return. So now what we're going to do, we're going to get to the fun stuff, and we're going to bring life insurance into the picture. Okay, we know about the investment. We have the investment. It's like, well, why use life insurance, right? A lot of people say like, what's so great about life insurance? Why should I use life insurance? Why should I put my money in life insurance first before putting in real estate? Why not just do real estate? Well, we're going to talk about that right now. And there's so many different types of life insurance out there. There's term, there's permanent, and within the term space, you got convertible term, you got, lifetime. Like there's so many different terms. And then on top of that, there's so many different permanent policies. What we're going to do is focus specifically on permanent, which is having a death benefit for your entire life. That is going to be specifically around whole life insurance. There's index universal life, there's GULs, there's variable universal life, there's ULs alone, there's lots of it. We're going to focus on specifically whole life insurance. And when we kind of think about this permanent life insurance contract, think of it as like a revolving line of credit. Revolving line of credit. If you're a sophisticated business owner and you understand, a sophisticated investor, you understand how revolving line of credits work. If you don't, I would encourage you getting your game up with understanding how lines of credits work in general. Just think of a credit card, but with a lot lower rates and a lot higher limits, and a lot easier to, have from a cash perspective. And so I think if you're a real estate investor and you're watching this probably intrigued you. Think of it like a HELOC. It's literally that, except for better. And better because the rates are lower. You don't have to have a scheduled payment when it comes to it. There's also a death benefit. There's lots of reasons around it, and we can talk about that now going forth. So why we like life insurance and why it's an incredible place to store capital. Remember, this is tandem, storing money. This is our safe opportunity fund bucket. We're now taking our dollars and putting in life insurance, waiting to deploy into an opportunity. It's safe. Okay, you can't lose money once your dollar's in. You're not going to lose money on it. Compounds over a period of time, that compound growth. We obviously know the compounding interest, the power behind that. You get tax advantages when this is set up and used properly and used correctly. You don't pay any taxes on this, not on the growth, not on utilizing it, not on the death benefit that's paid out, which is the next benefit. Death benefit, large lump sum to pay out to your family, to either pay off for debts, have them have income for the rest of their life, help with any of the real estate going forth. When you pass, be able to help with estate taxes, be able to pass down from a church, be able to pass down to nonprofit. You really can create a massive legacy for yourself, having your dollars do more than one job. The reason why this is the case is we're not using our own money when we're using life insurance. Our money is actually being sat there as collateral, and then we can borrow against it to be able to then use for the real estate deal. And so just kind of think of like the HELOC, right? In theory, you have this money that's sitting there in equity, but you're not actually like using quote unquote your money. The bank is letting you borrow, right, against your property. Your property is the one that's actually has collateralized on. And if you default on the loan or anything like that, they'll come and take your home. So instead, they're like, all right, you have this equity in the property. We'll give you a loan against it. And then you can go ahead and use the capital as you wish. It's the same thing with life insurance. And when you buy a home, you put money down into it. You take money out of your pocket every month and you put it into the property to pay your payments, your mortgage payments. That equity continues to rise. The same thing with life insurance. Every single month you're putting money into a life insurance contract. It's continuously growing, and then you can consistently borrow against it and use it. You're using leverage. The rates are a lot lower, way more competitive when it comes to this life insurance than it does when it comes to HELOCs. HELOCs right now are anywhere from 9 to 10%, obviously depending on your credit score. When it comes to life insurance, it has nothing to do with your credit score or anything like that. Rates are anywhere between 5.5 to 6.2% right now. And that is a variable. And that really keeps up with the Moody Bond Index and how well, or not how well, but how the economy is performing and what all that looks like at the time. So there's lots of advantages to using life insurance when it comes to just the basic characteristics of it. So what we're going to do next is we're going to actually look at the real numbers and talk about that and get a little bit more excited about why life insurance is an incredible place to store money and then borrow against to use for real estate. Okay, so we're going to look at whole life insurance and we're going to look at the 5-year window within the deal. So when we looked at it previously, a couple slides before, we already talked about the deal flow, the cash flow, the return on the investment for the life or the real estate. Now we're going to do the same thing for the whole life. There's a lot of moving pieces from it from a standpoint of how you would fund this. How you can fund this can be so many different ways. In life insurance, you make payments every single year. Okay, so this is going to give us a conceptual idea because we're going to say we're going to have some money already in life insurance. But just know, like, usually every year you're, at least for 7 years, you're making a contribution. If it's 10, 20, 30, 40, 50, $100,000 a year, 200,000, like the number is really going to be based off of your cash flow, your headspace, what you understand, all of those fun things. But what we're going to do in this is we're not going to say, okay, we're going to take cash flow and constantly keep putting it back into the real estate or the life insurance deal because it makes things extremely complicated. What we're going to do is we're going to give a really high-level overview of how the life insurance will work, knowing that it's a line of credit, and saying we have $300,000 in our life insurance policy, and we're going to go ahead and borrow against that to then go use for this real estate deal. And of the $300,000, we're going to use $100,000 to then go ahead and do so. All right. So with that said, when I say line of credit, think of the total cash value. Again, this is what's being collateralized. Okay, you have $300,000 in there. We're going to borrow $100,000 of this $300,000. Okay, to go ahead and then use for this real estate deal. So even though we're going to borrow $100,000, our $300,000 is still getting the full returns of the life insurance. And what I would say over a long period of time, okay, life insurance is going to reap anywhere from 4 to 5% internal rate of return. That's going to also depend on how much you're funding, the company you go with, how it's designed, and also your health is going to be a massive piece to that as well. Obviously, the younger you are, the healthier you are, you're going to get a little bit more advantages when it comes to the returns. But I think from a safe perspective, we can say 4% is a very conservative number over a long period of time we can see. So what we're going to do is we're going to say, okay, even though I'm using $100,000, my $300,000 is still getting the full amount. So we're going to do 4% per year on my $300,000 line of credit. So just think of this as your property. Your property every single year is appreciating 4% every single year, growing. Okay, that's kind of like the mentality. Just want to put something that's familiar with you. 4% every single year, it's going to continue to grow. First year, 312, second year, 324, all the way up to year 5, $365,005. So the total growth over the 5-year window is going to be $365,000 is what the total amount is grown to. So the growth is $65,000 over a 5-year window. Now we're going to talk about the loan costs, which we're borrowing against our policy to be able to use for this real estate deal. So we are borrowing $100,000 of this $300,000. Okay. Our loan costs, we're going to say, is about 5%. Make it easy. Like I said, right now, currently it's anywhere from 5 to 6%. And someone may be asking, like, well, why would I, put my money into something that's getting 4%, right? But when I borrow, I get 5%, like that's a -1 spread, right? So here's what I'll say. If we were to do a max loan of $300,000, okay, and a full return of $300,000, yeah, you would be in negative amount. Right? It's just math. Like 5% is higher than 4%. So yeah, it's obvious there. If we're going to max leverage this thing all the time, 100% of the time, and not get any positive returns on the other end, because what we're doing is we're borrowing to go get a higher rate of return than what we're borrowing at. So if I borrow at 5%, but my internal rate of return on the real estate was 16%, well, that's an 11% spread. And then on top of that, I'm also getting a 4% return over here, right? So there's a 1% negative delta, but then there's also a 16 or 11% positive spread on the other side. So that is something to consider, is that as long as we're borrowing against this, borrowing to get a higher rate of return than what we're borrowing at, well, then it's always going to work out at the end of the day. But if you're borrowing at a lower at 5%, but you're getting a lower rate of return than this 5%, let's say you're actually only getting 3%, well, then it's going to be really bad because now we're putting our money into something that's getting a lesser return than what we're borrowing at. And on the same time, you do have a spread delta between these two, which is that -1. So what I will say to this is always borrow and try to get, not try, but go get something that's greater than this. Remember, this is our foundational place to store capital. Okay. So that's the first thing. Secondarily, if we do this appropriately and right from a risk management perspective and actually understand cash flow and how money works, I am getting 4% on 300 grand. That yield me 12,000 this first year. I get 5% on 100 grand. That negative 5,000. I still made $7,000 between the two. Okay. So as long as even though 5% is a higher number, if you're borrowing on less money, right, than what you're actually growing on, well, you're always going to still be ahead at the end of the day. So from an arbitrage perspective, if that's what we want to talk about, which it's not necessarily it's not the end all be all. I'm telling you, there's so many benefits to this at the end of the day that this is just one deal. If we're using it appropriately, managing it correctly, it's great. And if you are going to borrow the full 300, that's also incredible. Just making sure that your other returns are going to now go blow it out the water and get 16% like you would in this deal. Because there's no point in saying, okay, I'm going to leave $200,000 in here just to get a positive spread between these two, knowing that $200,000 that's still sitting here, right? The difference between these could be utilized and going to get 16% somewhere else, right? That's a way better return than 4%. When you're getting 16% in somewhere else over here. Okay. But again, you have to understand how money works, velocity of money. This is for very sophisticated people when you're starting to use it from this investment side of things. But this is how real wealth is created, and this is how real wealth is built. When you start undering returns and you start undering loan costs, you start understanding lines of credits and how money works and velocity of money and moving money from one place to another. And understanding the basics of this, if you can really get this and grasp this concept, you're going to be in a such better place when it comes to creating wealth than 99.9% of all people. So when we come back and look at this, we're going to bring it back, regroup 5% per year, 5,000, 110, so on and so forth. The total cost was 27 grand. So we had a total growth of 65 grand and a $27,000 essentially cost to borrow of this 100 grand. Okay. So we took 100 grand, put in this real estate deal. It cost us 27 grand and we grew to 65, all just in this whole life insurance bucket alone. We didn't even talk about the real estate yet, right? So that delta between that 65 and 227 is we actually made $37,000 still in this thing where money is growing here, doing all of its fun stuff. We made 37,000 and our $100,000 is still over here in real estate, doing its thing, getting all of its other benefits. You can pay back on our terms. It's unstructured, pay back when you want, how you want, however you want. You recapture the term cost. You don't really need to pay term costs anymore because you have a permanent death benefit that lasts for your entirety of your life. Now, there are some times where you still maybe need some term coverage because your death benefit's still a little too low with the way that we're structuring things. The way that we structure these whole life contracts is minimize the death benefit and maximize our cash value. Lowers our commissions, but in the commissions of the agent, but it maximizes the growth of the contract. But by doing so, the death benefits minimized. So therefore, you may need to supplement some term insurance to have protection for your family still. But sometimes you may be suffice and have enough death benefit. No taxes are paid. We already talked about that a little bit. When this grows, okay, it's going to grow tax deferred. You don't have to pay any taxes as it grows. And when you borrow, because the IRS sees debt, borrowing against your policy is debt, they don't say, hey, you're borrowing, so therefore you now pay taxes on the money when you use it. It's debt, therefore no taxes are having to be paid. And when the death benefit gets paid out, there's no taxes that are paid to your heirs as well in 99.9% of those scenarios. So that's why you get lots of tax advantages. And then there's something that I think is rarely talked about is the interest. It's $27,000 of interest that's charged into our loan cost. We also can write off on our, for our tax purposes as well. Now, this needs to be documented appropriately. You need to talk to your tax person. And a lot of the times getting it set up with a third-party line of credit makes things really easy because they document a lot of that. They document the 1099. Doing it by yourself, I think at the end of the day, just could be a little dangerous for sure. So that's why you want to talk to some professionals. When you're looking at this perspective, $27,000 of write-off, it's a pretty big, I mean, obviously it's a 5-year window, right? So, but still 5,000 here, 10,000 here, 15,000, like it's actually not that much. It'd be 5,000 here, a little over 5,000 again, a little over 5,000 again, 6,000 here. So when you're starting to look at that perspective, it's not as large, but it's still anywhere from $5,000 to $6,000 per year is more than, if you're in the 30% tax bracket, it could save you an extra $2,000 that you're not coming out of your pocket at the end of the day. Then that's not even talking about all the other advantages that obviously come with the real estate and the opportunity that we're using here to be able to use our dollars. So with that being said, let's go ahead and piece this all together, look into life insurance and the real estate and see what we can come up with. All right. So the the real estate, 5.3%. We talked about that year after year, cash value growth year after year. I'm not the person that likes to add these together and say, oh, you're now getting 9.3%. But if you're looking at your actual dollar returns, that's kind of what's going on here. You're getting 5% in one asset, 4% in another asset, 9.3%. Total real estate, 26,508. That's per year. Again, why is this the case? Is because you're only putting $100,000 into the real estate, okay? And it's $300,000 that's growing on the life insurance. So you can see larger money both directions, right? Whether it's on the loan cost or whether it's on the investment, you're always going to reap a little bit more on that side of things, okay? And this is just cash flow, okay? This isn't talking about the return on sale that we're going to talk about next for the real estate deal. $91,000, 513 total of dollars for the real estate deal, okay? Or real estate plus life insurance of actual cash flow over a 5-year window, okay, is what you're essentially reaping from that perspective, which is pretty good. If you can get an extra $20,000-ish, or $17,000-ish per year in extra cash flow, it's coming into your possession. I think that's pretty great. This is how you really start to build wealth. And this is just one property, right? One policy, only $300,000 of money in life insurance. Start looking at bigger numbers and you can really start seeing how freedom is right around the corner. When you sell the property, where we said $178,000, so you take the $178,000 plus the 91, the total over the 5-year window is at $270, right? Now we got to remember we do have the loan costs, okay? So the 5% on the $100,000, it's going to be $27,000 over the 5-year window. So we take the $270, right, which is our total return of all of these together, the property sale, the cash value, the cash returns over the 5-year window, 270 minus the loan cost, that nets us a $746. Now remove our principal, and this is going to get us a total profit of $142,746. Okay. And again, this is specifically just looking at the numbers. We're not even talking about all the other benefits that come with this. The benefits of peace of mind, knowing that we still have another $200,000 of opportunity fund that's sitting there for other deals, right? The tax advantages that come with the life insurance, the tax advantages that come with the real estate. If you're not familiar with that, you got depreciation. You can 1031 to another deal to consistently wrap that tax wrapper to never have to pay taxes, so you can keep that going. You put both of these two assets together, there's so many tax advantages that come with it. Life insurance and real estate together, two of the most tax advantaged vehicles that you have on the planet together. The death benefit, that's their tax-free. You have the volatility buffer that we talk about sometimes, where you're going to retirement, your investments kind of go on a downslope, and like in the market-based activity. If you're somebody who invests in the market, you can now use your life insurance as cash flow while the market then recovers. If you're someone who's diversified, I know there's a lot of people that are either in crypto or that are in the S&P or that invest in individual stocks for the long haul. I'm not going to go into all of the characteristics that life insurance can provide and that real estate can provide. We've talked enough about them. But what you can see is that if you can keep doing this once and then do it again and then again and then again and keep doing this rinse and repeat, where I put my money into life insurance, I borrow against it, put into real estate. The real estate does its thing. It cash flows, it appreciates. You sell the property, you take the funds, you then put it back into life insurance, and then you do it again for another deal. And then along the way, you may now have 2 deals and 3 deals. Imagine doing this. You have long term, okay, you've been doing this for 10, 15 years. You have $500 to $1 million of, let's just even say $150 to $1 million of a line of credit of life insurance that you can borrow against and use. And you have 4 or 5 different real estate deals that are out there that are more on the passive side, right? And eventually, if you're somebody who really loves real estate, you could eventually get into a more active side, or you can now invest into you're now the general partner, right? Because there's more upside when you're a general partner and just more time and energy, right? You could then start shifting over and start taking other people's expertise and then start making it into your expertise, and now start learning the skill sets by surrounding yourself. That's the other cool part about being a limited partner is you can ask all the questions you want. And the general partners are usually very open to sharing with you how things are working, why things are great, the bads, the pros, the cons. Start talking about cap rates, the capex, the cash flows, the IRR, all of these different numbers that some of you may already be familiar with, or some of you may not be, and you're like out here trying to learn, that come with it. And so with that being said, I hope this helps. I hope that gave you some context to why using life insurance with real estate in co-tandem together is an incredible, powerful tool to help you build wealth. And with that being said, thanks again for watching. And until next time, stay easy.